Welcome to the Deep Dive.
Today is September 4th, 2025.
And we're jumping straight into Guidewire's latest results. Q4 and fiscal year 2025 just dropped.
Yeah, hot off the press. Our goal, get straight to the key insights, figure out what these numbers really mean for them going forward.
Okay, let's unpack this then, because the feeling over at Guidewire seems really positive.
Euphoric, you might say.
Right. CEO Mike Rosenbaum called it an outstanding fourth quarter. He mentioned specifically 19 cloud deals.
19 is a lot.
It is. And the big one for me, surpassing $1 billion in ARR, that's annual recurring revenue.
A huge psychological and financial milestone.
And he also flagged that significant 10-year agreement with a major Tier 1 insurer, called it proof of platform maturity.
Which that Tier 1 deal definitely is. I mean, a 10-year commitment from a massive insurer,
Yeah.
that's not just a sale, that's locking in a partnership.
Yeah.
It shows deep trust in their cloud platform for the long haul.
De-risks things a bit too, doesn't it? For that customer at least.
Absolutely. And what's interesting here is how these comments from leadership, they're backed up by some really solid growth numbers. It's not just talk.
Okay, so what are we seeing?
Well, it looks like acceleration. Guidewire reported 19% growth for ARR, then 22% for fully ramped ARR.
Okay, what's fully ramped ARR mean quickly?
Right, so that's basically the annualized revenue once all the current cloud contracts are fully up and running, scaled up, gives you a better look at the future potential, not just today's book number.
Got it. More mature picture.
Exactly. And total revenue for the fiscal year, up 23%.
Wow.
And it wasn't just about revenue growth. They showed a strong operational discipline, too. Cash flow from operations margin was 25%.
That's pretty healthy. Shows efficiency.
Mm-hmm.
Okay, so let's zoom in on the actual fiscal year 2025 numbers. Ended July 31st. Total revenue hit $1,202.5 million.
That's the 23% jump you mentioned from fiscal 24.
Right. But the key number, I think, for their cloud story, subscription and support revenue, $731.3 million. That's up 33%.
That's the real indicator of the cloud pivot paying off, isn't it?
Absolutely. And ARR, officially over the line.
Yeah.
$1,041 million. That's 19% growth constant currency.
Crossed the billion-dollar mark.
They did. But here's something else huge, I think. Profitability. They went from a GAAP loss from operations in FY24, $52.6 million loss.
Yeah, I saw that.
To income of $41.1 million in FY25.
That's a massive swing.
Huge swing. Same story for GAAP net income. From a $6.1 million loss to nearly $70 million income this year.
$69.8 million.
And then non-GAAP net income, which gives maybe a clearer operational view, $227.9 million.
That's from $114.5 million last year. Almost doubled.
It's a big jump.
And that switch from GAAP loss to GAAP income, that's really a critical turning point.
Why is that so significant?
Well, for you listening, non-GAAP often strips out things like stock-based compensation, amortization, non-cash stuff. It can give a cleaner view of the core business performance.
Right.
But hitting GAAP profitability, that signals real financial health, maturity in the cloud model. It might even attract a different type of investor who looks specifically for that GAAP number as proof of stability.
Okay, that makes sense. And speaking of performance, let's look just at Q4. The quarter ending July 31st, total revenue, $356.6 million.
Up 22% year over year for the quarter. Strong finish.
Very strong. Subscription and support again, up 33% to $201.9 million.
Consistent theme there.
And the big beat for the analysts, non-GAAP EPS was $0.84.
Yeah, the estimate was, what, $0.63?
$0.63. So they beat by $0.21. That's substantial.
Definitely. And revenue beat too?
Yep. $366.57 million versus the consensus of $337.85 million. Comfortably ahead.
So if we connect this to the bigger picture, these consistent beats, especially on revenue and EPS, it really screams strong market acceptance.
And execution.
And solid execution, exactly, especially on the cloud strategy. They're not just migrating people, they're making money doing it.
Right, the model's working.
It seems like it. Validates all that investment they've poured into the cloud platform over the years.
Okay, past performance, impressive. But you know me, I always want to know what's next.
The forward guidance.
Exactly. And here's where it gets really interesting. Their projections for fiscal year 2026, they seem pretty ambitious.
They're certainly not resting on their laurels.
No. So for Q1 FY26, they're guiding ARR between $1,048 and $1,054 million. Total revenue, $315 to $321 million.
Okay.
And non-GAAP operating income, $47 to $53 million. That's just Q1.
And for the full year, FY26?
Full year ARR. $12,210 million to $1,220 million, so crossing $1.2 billion. Total revenue, $1,385 million to $1,405 million,
Wow.
almost $1.4 billion there.
Wow, okay.
Non-GAAP operating income, $259 to $279 million, and operating cash flow, $350 to $307 million.
That's projecting quite a bit of continued momentum.
It really is. It feels like a blueprint for more high growth.
And how does that stack up against what analysts were expecting? Because that's key.
Right. Well, it looks like a guidance beat. Their Q1 revenue guide, $321 is definitely higher than the consensus of $301 or 4 cents.
Okay, so beating for Q1.
And the full year, too. Their FY26 revenue guidance, $1.39B just to $89.41, is also above the $1.35B consensus.
So they're guiding above expectations across the board. That raises an important question, doesn't it?
Which is,
what's driving this confidence? I mean, guiding above consensus suggests they have really clear visibility into their sales pipeline, right?
seems likely.
And real confidence in closing those big cloud deals. Maybe it also implies their product, especially with AI baked in, is giving them a stronger competitive edge.
That could be, making it harder for others to catch up.
Exactly. This isn't just optimism. It feels like a strong signal about their market position and traction.
Well, the market certainly seemed to like the signal. Shares jumped 3.62% right after the announcement.
Immediate positive reaction.
Yeah. Now, context for you is important here. The stock had been a bit choppy lately, down about 15% in the last 3 months. But zoom out to 12 months, it was up over 50%. So strong, long-term run-up, recent dip, and now this pop on the results.
That context makes the 3.6% jump more meaningful, I think. Shows the result overcame recent negativity.
And what about the analyst community overall?
Mostly positive. The average target price from 12 analysts is around $249, suggesting, maybe 15% upside from where it was trading.
Wow.
But there's always a range, right? High target, $290, low, $160, big spread.
Always is.
But the average recommendation is 2.1 on that 1 to 5 scale where 1 is strong buy.
So basically an outperform consensus.
Yeah, from about 15 firms. So generally, Wall Street seems pretty bullish.
Okay, mostly bullish from the analysts. But we always like to give you a rounded view. We saw a different take from GuruFocus.
Ah, the GF value. What's that saying?
Well, it projects a future value of $149.09, which, compared to the current price back then, implies a potential downside of over 30%.
Wow, that's a stark contrast to the analyst target.
Big difference.
And what's fascinating there is it really shows how different valuation methods can lead to wildly different conclusions, especially for a company in transition.
How does GF value work, generally?
Well, it uses historical trading multiples, past growth, future forecasts, but it might weigh those historical multiples quite heavily.
Which might not fully capture a major business model shift.
Exactly. If a company is fundamentally changing, like Guidewire moving aggressively to cloud and now hitting GAAP profitability, historical multiples might not reflect the new reality or potential. So GF value offers a valuable check, maybe a more cautious view, but it might be lagging behind the company's transformation.
So different lenses giving different pictures.
Yeah.
Useful to know. Okay, stepping back for a second, for anyone less familiar, what is Guidewire at its core?
Right. They're basically the software platform for property and casualty insurers, the P&C world.
The ones covering homes, cars, businesses.
Exactly. Guidewire provides the systems insurers use to, engage customers, innovate with new products, manage policies, handle claims, billing, the whole operational backbone.
And they're global.
Oh, yeah. Over 570 insurers, 43 countries, big names, small names. Their big focus now is delivering all this through their cloud platform.
Integrating data, analytics, digital tools, AI.
That's the push. Cloud platform excellence, as they put it.
And connecting this back to the results we discussed.
Well, the strong cloud deals, the ARR growth, it directly validates that strategy, right?
Yeah.
It shows insurers are buying into their integrated cloud vision.
Makes sense.
And they talk about 1,700 plus successful projects, having the industry's largest R&D team, a huge partner network. That all speaks to their ability to actually deliver on this complex stuff. It's not just software, it's implementation, support, the whole ecosystem.
Right. It's a big undertaking for these insurers to switch platforms.
Massive.
Okay, one last important point. Like all companies, Guidewire includes the standard cautionary language concerning forward-looking statements.
The legal boilerplate, yeah.
That important. It is. Just reminding everyone that projections are projections. They're subject to risks, market changes, relying on big customers, Cloud adoption costs, global events, competition, even AI development challenges they mentioned specifically. It's just crucial context for you to keep in mind.
Absolutely. And framing that, it sort of raises a key question for any growth company like this.
Which is,
How do you balance setting those aggressive growth targets, that optimistic guidance we saw, with managing all these inherent risks?
it's a tightrope walk.
It really is. Acknowledging potential headwinds, competition, regulations, tech hurdles, while still executing confidently.
Right.
It's a reminder that even with great numbers, the future always has uncertainty.
So wrapping this up, what's the main takeaway for you? Guidewire clearly delivered strong FY25 results.
Definitely. Impressive growth, especially in cloud revenue.
They hit GAAP profitability, which is a big milestone.
The cool step.
And their guidance for FY26 is optimistic, beating analyst expectations. Seems like their cloud strategy is really hitting its stride.
Yeah, the momentum seems strong. They're executing well.
So the final thought for you, our listener, to ponder on.
Given this strong performance, this ambitious guidance, all driven by cloud and AI, how is this ongoing tech innovation going to keep reshaping the insurance industry itself?
Good question.
I mean, what's the next big thing these P&C insurers will be demanding? Is it even more sophisticated AI for underwriting? Or maybe truly instant touchless claims? Or is it something completely different we haven't even thought of yet? Where does Guidewire or its competitors go from here?